How did free banking systems succeed historically? Imagine a world where banks could create their own money, backed by real assets, and compete freely without a central authority. That's what free banking systems were all about. They worked by letting banks issue their own currency notes, which were backed by things like government bonds or mortgages. This meant the notes could be exchanged for gold or silver on demand, making them trustworthy. Because banks had to keep enough reserves to honor these notes, they stayed disciplined and avoided reckless lending. In the United States, starting in 1838, New York's free banking system showed how well this could work. Banks had to back their notes with state bonds or mortgages, which kept the system stable. When banks failed, losses to note holders were often very small, sometimes just 3%. The notes from New York banks kept their value even outside the state, showing strong confidence in their stability. This helped New York City grow as a banking hub, surpassing Philadelphia by the time of the Civil War. In New England, the Suffolk Bank played a key role. It was a private clearinghouse that helped banks exchange notes and kept them from overissuing. This created a kind of private, competitive oversight that kept banks honest. Because they had to maintain good reputations, banks issued safer notes and avoided failures. Scotland's free banking system also did well. It allowed joint stock banks with unlimited liability, meaning owners could lose everything if the bank failed. Failures were rare, losses were small, and the system helped connect savers with borrowers efficiently. It also improved payments, making everyday transactions smoother. From a libertarian point of view, these examples show how markets can regulate themselves without heavy government control. Competition among banks kept them honest and stable. When failures did happen, they were usually due to legal restrictions or political meddling, not free banking itself. Free banking succeeded because banks issued currency backed by solid collateral, which built trust. They had to keep reserves to honor their notes, which kept them disciplined. Competition encouraged innovation and efficiency. Private clearinghouses helped manage note exchanges and enforced discipline. And avoiding government monopoly kept inflation in check. All of this aligns with libertarian ideas of minimal government, property rights, and free markets. The history suggests that free banking can be a practical alternative to central banks, supporting a stable and free economy.